Hello and welcome. I'm Andrew Howard, Chief Investment Officer here at Equip Super, and I'd like to welcome you to this investment update for the quarter ending 30 September 2024. While we saw increased equity market volatility during the September quarter, the ultimate outcome was another quarter of positive returns delivered to our members. This follows on from the strong financial year results that we shared with you in our previous update. Share markets, both here and abroad, continued their positive upwards momentum, headlined by the Australian share market, which returned 7.8% for the September quarter. In the US, the S&P 500 index rose by 5.9% over the quarter. So it was equity markets that continued to be the main driver of returns for fund performance, which is the theme that played out over the course of the last financial year. I'm pleased to report that our MySuper investment option delivered a return of 3.3% for the September quarter. And with the strong tailwinds of equity markets still the driving force behind performance, the one-year return for the MySuper option was a very healthy 13.37%. As we reported on in our last update, equity markets benefited our higher growth options, and a very similar theme played out this quarter, with our Growth Plus option returning 17.18% for the 1 year to 30 September 2024. The positive investor sentiment seen in equity markets over the quarter was driven by several key macroeconomic developments, which included the US Federal Reserve's decision to begin easing interest rates with a large 0.5% cut in September. We also saw the Chinese government announce significant stimulus measures in September, in a bid to boost confidence in capital markets and the struggling local property sector. Inflation also continued to trend down, with US inflation moderating but still above the Fed's 2% target, while euro area inflation fell to within the European Central Bank's target range. This resulted in a very positive backdrop for global share markets. Fears of recession, which was viewed as a near certainty earlier this year, have abated. This was replaced by an acknowledgement that the macroeconomic environment, having withstood high interest rates for some time now, has proven resilient. In a historical context, soft landings are rare, but it seems increasingly apparent that central banks have threaded the needle, at least for now. The US economy continues to power ahead. Inflation, while still a little too high, continues to moderate, which provided the US Federal Reserve with the confidence it needed to deliver its first interest rate cut of this cycle. Markets expect the interest rate cuts to continue, with another 5 cuts forecast by the end of 2025. With the US economy continuing to demonstrate such resilience, a rate-cutting cycle of that extent would be unusual. As history tells us, it's extremely rare for the Federal Reserve to cut rates so aggressively when the US economy is not in recession. So there remains the potential for a repricing in market expectations, which could create volatility within equity and bond markets at some point in the future. As mentioned at the outset, we did see a period of heightened volatility during the September quarter. In early August, we saw some of the sharpest falls we've seen in equity markets since the onset of COVID back in early 2020. Volatility was due to stress appearing in Japanese currency and equity markets, along with concerns of a weakening US economic outlook. As we now know, this risk-off sentiment was extremely short-lived, and equity markets recouped the falls in a matter of weeks. It reinforces that we need to be extremely cautious about reacting to short-term market events. As the chart shows, the falls in August are extremely difficult to detect when looking at the long-term performance of the US equity market. It's a reminder that it can prove extremely difficult to time markets in the short term. In an environment where valuations are stretched and markets are driven by momentum, it can literally be one piece of economic data that can cause investors to rush to the sidelines. This is why we believe it's important to retain a long-term investment lens when making decisions and not react to short-term noise. So in an exuberant market environment like the one we're currently enjoying, with equity markets continuing to reach new record highs, the question we continue to ask ourselves is what will bring this extraordinary bull market to its inevitable conclusion. Right now, it does not appear that there's anything swaying investor euphoria. But with a US election now only days away and the policy platform of both candidates showing little appetite for fiscal constraint, and by the time you watch this, we may well have a new president in the White House, plus a lingering question over whether the stimulus measures introduced in China will be enough to kickstart growth, as well as the ongoing geopolitical tensions, we remain strategically cautious. Our strategy is certainly benefiting from the continued strength of equity markets, but we retain our conviction in ensuring that the portfolio is well diversified to contend with both rising and falling markets, and as such, we're not tempted to chase short-term returns with markets remaining at record highs. If you'd like to find out more information, please head to our website. Thank you for watching.